Hello and welcome back to Global Value. In today's video, we are going to be performing a fundamental stock analysis of Altria Group Inc., ticker symbol MO. Altria Group has one of the highest dividend yields in the entire stock market. Currently, they have a dividend yield of 7.85%, and they consistently pay out a very large percentage of their cash flows as dividends. Altria is the American tobacco operations from Philip Morris, which over the past 50 years has been one of the best performing American businesses. At the time of recording today's video, Altria is trading for $45.88 per share. Year to date, their stock price is down 3%. Over the past year, their stock price is down 5.7%. Over 3 years, they're about flat. Over 5 years, they're down 28.5%, which is down 6.5% compounded annually. Over 10 years, here we see that they're up at a rate of about 3% compounded annually. And going back prior to the global financial crisis, their stock price is down 28%. However, this is a bit misleading as they had a spinoff of Philip Morris in April of 2008. So from the price after their spinoff, the business is up about double over the past 15 years or so. So currently, Altria is trading about $4 above their 52-week low, which is down quite a bit from their 52-week high. They are a very large tobacco business with an $82.5 billion market cap. So for some background about the business, Altria comprises Philip Morris USA, US Smokeless Tobacco, John Middleton, Helix Innovations, and Philip Morris Capital, though the company plans to wind down Philip Morris Capital by the end of this year. The company provides cigarettes primarily under the Marlboro brand, cigars and pipe tobacco typically under the Black & Mild brand, and smokeless tobacco products under Copenhagen, Skoal, Red Seal, and Husky brands, as well as on-oral nicotine pouches. Altria holds the leading position in cigarettes and smokeless tobacco in the United States, and the number 2 spot in machine-made cigars. The company's Marlboro brand is the leading cigarette brand in the United States, with a 43% market share as of 2020. Altria also holds strategic interests in Juul Labs and Kronos. So Altria Group was founded in 1822 and is headquartered in Richmond, Virginia. So for today's fundamental analysis, we are going to be performing the Select 6 analysis, taking a checklist-style approach of using 6 standard financial metrics to come to a holistic and beginning understanding of Altria Group as a business based off of their fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. So it will continue to improve and get better over time. So with that background about Altria Group and this disclaimer, let's get right into our analysis. Starting off, the first metric that we want here is a return on capital that's above 14%. So over the course of decades, a stock is going to return approximately what its underlying business returns, and these underlying business returns are captured here by return on capital. The second reason is why we want this above 14%. The average publicly listed business earns about 7% return on capital, so wanting businesses that earn above 14% on their return on capital gives us a margin of safety in the quality of a business that it's at least twice as good as average. So Altria Group earns very high returns on capital. Over the last 5 years, they've averaged just under 30% returns on capital. Their returns on capital have been increasing since 2018, and they've been doing quite well since the coronavirus pandemic. This is a check for our first metric to start off here. Next up, we're looking for their revenues, net incomes, and free cash flows to have grown over the past 5 years. So this is an all or nothing metric that gives us a high-level overview of the company's financials. Either all 3 of these metrics have been growing for a check, or if even one of them has been down, this metric's going to be an X. So they've been able to slightly increase their revenues, and they've more than doubled their free cash flows. However, their net incomes have come down quite a bit. This comes on the back of a couple of things such as income taxes. The primary driver of this is continued write-downs on their investment in Juul Labs, which is their largest e-cigarette. This is going to be an X here on our second metric. Metric number 3, we're looking for earnings per share growth over the last 5 years. This metric is going to be an X as well for the same reasons as the last metric. This metric is pretty similar to the last metric. However, it also takes into account shareholder dilution. So here we get a glimpse that Altria has actually been buying back shares over this time frame. So far through 3 metrics, we are only 1 for 3. Metric number 4 is going to be similar to metric number 3. However, here we're looking at their free cash flows per share. Over the long run, earnings per share and free cash flows per share should be about even. Here we get a glimpse at why these metrics can differ. This investment write-down is not going to affect the business's cash flows in any way, but it does pass through their earnings. So metric number 4 is going to be a check here, as Altria has grown their free cash flows from $2.45 per share in 2017 up to $4.46 per share in 2021. So this is our second check here on metric number 4. Metric number 5, we want their net debt, which is long and short-term liabilities minus cash and short-term cash equivalents, to be below the amount of free cash flow that they produced in the past 5 years. So we're taking all of these free cash flow numbers and adding them together and comparing them to their net debt from this most current year. This is going to help us evaluate how the business utilizes debt. It's very important that we don't invest in businesses that have too much debt relative to their abilities to produce free cash flows, as overly levered businesses are ultimately going to do the worst during financial downturns. We're comparing this against free cash flow because free cash flow is the lifeblood of any business. A business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what the business is going to be worth. So businesses can use free cash flows to pay dividends, buy back shares, pay down debt, make acquisitions, or reinvest back into the business. In the case of Altria, at the end of last year, they had $23.5 billion of net debt, and over the last 5 years, they produced $36.8 billion of free cash flow. So this is going to be a check here on metric number 5. The business is earning more than enough free cash flows to be able to pay off all of this debt and then some. So the business is using an appropriate amount of leverage based on this metric. Then for metric number 6, we want their average 5-year free cash flow yield to be above 5% relative to their total enterprise value. Total enterprise value gives us a realistic economic picture of what Altria would be like as a private business. Enterprise value is their market cap plus their net debt position. Altria has a total enterprise value of $108 billion currently, and in an average year, Altria is producing about $7.36 billion of free cash flow. So when we divide $7.36 billion by $107 billion, that's going to give us an average 5-year free cash flow to EV yield of about 6.9%. So this is above that metric we're looking for. This is going to be a check on number 6. And so relative to the risk-free rate, it looks like Altria is offering a potentially attractive risk premium here. Here we're taking a look at Altria's dividend profile. So people make mistakes all the time by blindly chasing dividend yield. Instead, it's important to look under the hood and look to see that a business's dividends are supported by their cash flows. So in the case of Altria, Altria is a very slow to no growth business. They pretty much reached saturation in the United States, and cigarette smoking is on the decline. Also, tobacco growth is very limited due to regulatory reasons, such as a forced lack of advertising. While Altria's position is very well entrenched in America, what this means is that we'd expect a business that doesn't have the opportunity to redeploy their cash flows to be returning most of their cash flows to their shareholders. In the case of Altria, this is exactly what we're seeing. In 4 out of these 5 years, they produced more than enough cash flow per share to cover this dividend. But even in those 4 years, they're paying out a very high percentage of their cash flows as dividends. So expect this to continue into the future. Whether or not these dividends per share will keep increasing like they have in each of the past 5 years, that's something that you'd have to do more work on the company, dive into their 10K, and read through management's earnings call transcripts to get a better understanding of how they're approaching capital allocation. Altria has used some money to invest into Juul and into cannabis companies such as Cronos, but for the most part, they're using their cash flows and returning them as dividends to shareholders. Then here we're using a discounted cash flow analysis to come to a potential fair value for Altria based on their historical growth numbers. Since the spinoff of Philip Morris, Altria has grown their cash flows at a rate of about 2% annually. So if we assume a 2% annual growth stage for the next 10 years, and then a terminal stage where the business is totally flat for the 10 years after that, then you could reasonably expect, with their tangible book value and their free cash flows per share today, about a 6% return on Altria. So keep in mind that this would be including their dividends, so we are not doubly counting their dividends here. So these are historical growth assumptions, and you'd want to validate for yourself whether or not these are going to be accurate and applicable to Altria going forward. However, if you determine that these are applicable, then based on this, it looks like Altria's share price would actually decline, and you'd be earning all of these returns based on their dividends. If instead you wanted to get a 10% rate of return from Altria, again based on these historical assumptions, which you need to validate, you'd have to wait for a fair value of about $31.50 per share to earn about a 10% return on Altria from today. Keep in mind that this type of analysis and this discounted cash flow model are not financial advice. They are not a buy or sell recommendation of any security. These are based on historical assumptions that you need to either confirm or disconfirm one way or the other. Before making any sort of investment decision, it's very important that you both do your own homework and that you consult with the properly licensed financial and legal professionals. So in summary, Altria checks the box on 4 out of our 6 standards. They're earning very high returns on capital, and their average free cash flow yield relative to their total enterprise value looks like it is potentially attractive at almost 7%, quite a bit above the risk-free rate, and could offer a nice risk premium there. The business is also utilizing appropriate levels of debt. We learned that they've been buying back shares as they've increased their free cash flows. Their earnings have taken a dive as they've continued having write-downs from their Juul investment. Also looking at their dividend profile, Altria is paying out a very large percentage of their cash flows to shareholders and returning them that way. And it would seem that that's going to be the plan going forward for quite a while in this low to no growth business. Given the fact that they have very minimal opportunities to grow their volumes, and a lot of their growth is coming on the back of pricing increases, then using historical growth assumptions, which you need to validate for yourself, in a discounted cash flow model to come to a potential fair value of Altria, it looks like you could reasonably expect about a 6% return based on today's prices. So this would include their dividends, and this would signal that their stock price is coming down from today's numbers. However, these are historical metrics, and they serve as just a baseline projection into the future. You need to do your own due diligence and learn more about the company to understand if these growth assumptions are accurate or not. This is not financial advice, and it's not a buy or sell recommendation of any security. It's very important that you do the work to learn about the business and that you consult with the properly registered financial and legal professionals before making any sort of investment decision. So with that said, that's it for today's fundamental stock analysis of Altria Group Inc., ticker symbol MO. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Altria with me, and have a great day.